The other thing is diversification. And we talked about this a little bit before. The idea is that you would go to an aggregator, and not an aggregator, fund, right? Fund manager, closed-end fund manager, or private equity shop, whatever it is, who would go out, and then you wouldn't have more than 10% in any particular deal. But you could almost have 1%. You could almost have half of 1%, spread it out. And the chances are overall, as long as there isn't any major macro impact, yeah, you're going to hit some pretty, you could almost do it in almost like a mutual fund, right? Invest so little and just aggregate it across so many deals that the chances of the entire portfolio, I mean, I'm just playing with ideas, right? But it almost leads to a different model altogether for investing very large sums of money. Ultimately, it's possible, right? I was actually coming at it from a different perspective, and that was the idea that because individual investors, ultimately pension funds, endowments, insurance companies, Chris, at the end of the day, they're investing individual people's money, right? You think of them as being, so they're really investing the same money that you're raising from individual investors. The same people, those individual investors are paying insurance premiums and, and writing checks to endowments and et cetera, et cetera. It's actually all coming from the same place. You could almost see a balance. My thesis is, my theory is, what's going to happen is institutions, instead of rejecting the idea of crowdfunding, which a lot of sponsors worry about, some of our clients who have only got institutions as our investors, I'm worried that they're going to not like us going to the crowd. Well, on the contrary, it's beneficial because the institution, I don't want to go too long on this. I've got 3 quick questions to ask you. But I want to make this point. The institutions now can look and say, hey, look, go for it. We really encourage it. In fact, instead of, why don't you add an extra 35%, allocate an extra fund, instead of 30% equity or 20%, do 25% or 35%, go to the crowd. And now we're actually servicing those people as well, because they're getting the benefits of our due diligence, our analysis, all the research we're doing. It's better for them, and they can diversify. They'll have investments through us, right? And their pension funds, which is the low risk, lower down the capital stack money. And they can have a flutter at the higher risk equity side, knowing that we've underwritten the deal. So I just think ultimately that's what you're going to see happening. Do you see a marriage between these two parts of the industry?
Well, I thought I had thought of everything, Adam, but I had actually never thought about that.